obviously very lucky today to have some very skillful in the trenches venture capitalists. I might let you introduce yourselves. I always think you do a better job introducing yourselves than most people do. So away you go.
Okay. So I'm Grant Chamberlain. I'm a partner at OneVentures. We're a later stage Australian VC. We have about 450 million under management, and probably unusually for a VC, we invest in technology and healthcare or biotech. Out of the one shop, usually that's you either do one or the other. We do both.
Hi, I'm Damian Fox. I'm from a venture fund called Carthona Capital. We started off investing on a deal-by-deal basis, and then in the last couple of years, we've gone and raised our first fund. So our first fund was a $100 million fund. Very early stage for our initial check, so usually pre-seed, seed, Series A is our initial investment, but then we like to invest pretty strongly thereafter and have invested actually into an IPO as well for an existing portfolio company.
Hi, I'm Andrey from Follow the Seed. I've been investing and building companies for about 22 years. Started probably 20-odd companies, invested in another 100 or so. In venture, in Follow the Seed particularly, we're a global data-driven fund. We operate across Australia, China, Israel, and US, and been pretty active. Did like 40 deals in the last 2.5 years.
Great, and I'm Alicia Macdonald from Airtree Ventures. We're currently investing out of a $250 million fund. We're industry agnostic, and we invest right from very early pre-seed, $200,000 checks right up to 25 million Series C checks.
Guys, I might just kick it off with a question. And venture capital, it's obviously not you guys, it's someone else's money. And a lot of people don't always even know what a venture capital firm is or how to, let alone how to approach. But I think it might be helpful if you could share with us how to think about a venture capital firm and what the makeup of a firm is. So, and obviously you're all different types of makeup and etc. But it might be helpful for everyone to just understand a little bit more about the context of venture capital and how the parts work a little bit, just to contextualise. And plus, by the way, these guys have to raise money themselves sometimes. So it's not just you guys that think, Jesus, nervous talking to VCs. They can get scared too.
I mean, I can kick that off. So at a very high level, so venture capital is investing in early stage businesses in return for equity or ownership in the business. As David alluded to, we have what we call limited partners, who are people that invest money into our fund for us then to manage, and the people who manage the funds are called general partners. So the limited partners are often high net worth individuals, or in our case, we have a mixture of high net worth and also institutional funds, so superannuation funds that invest in our fund. As David mentioned, we're out fundraising in market, and we raise capital from both those high net worth and institutional funds to put into our fund. Our job is then to find the most exceptional founders in Australia and New Zealand to put that capital to work, and then return that, hopefully much more money than was invested into the fund back to those limited partners. It's typically, each fund has slightly different terms, but over a 10-year period that those limited partners will part with their capital, and we're hoping to generate a return. So typically target sort of an IRR, internal rate of return, which takes account of the time value of money, but essentially sort of 25% annually.
Fantastic. Well, on that basis, again, we talked about, there's a lot of founders in the room. What's the right time to approach a venture capital firm? Is it as soon as possible? Is it go and ask for advice and you might get some money? Or what do you tell founders? And obviously you've all got a different investment time frame, but what do you tell founders in terms of the right time to approach a venture capital firm? Damian, you want to take that one? Or Andrey, look keen?
So for us, I think as early as possible. So day one, even before founding incorporating the business, I think the earlier you can be speaking out to us, the better. Not only can we sort of give you some of our thoughts and how we're thinking about the opportunity, and potentially give you some advice there. Similarly, we just want to be in touch with you from day one. We're slightly different from for example, from Grant, who they're going to want to see you later down and they'll probably tap on a few early stage investors to speak to that, to get their thoughts on how things are going. But yeah, from day one really.
Yeah, so I would say probably about 5 years before, and basically. At the end of the day, it's very personal business, and it's definitely worthwhile getting to know the counterparty. So I think my record was probably about 8 years working with the entrepreneur before investing in them. But I mean, on average, it's easily a few good years, and not necessarily in the same company. So I mean, I'm more than happy to kind of follow their progress and help them out in one company and then invest in their next company. But it's essentially a relationship building exercise. And when people are coming to us and they're looking to raise the round and close it within the next 3 months, it's kind of, like, I mean, do you really want to date someone and in 3 months get married and, start a family? I don't know, maybe, but probably, you might start a little bit earlier. And indeed, I think a lot of the venture capitalists in Australia are very approachable. A lot of them, go to all these events. They mentor a whole bunch of accelerators and whatnot. And I think generally fairly approachable. So I definitely encourage founders, to talk to them, and not necessarily when they actually need the money, kind of, the next morning, because it always helps just getting to know the people and sometimes using them as a sounding board. And at the end of the day, VCs do get across a lot of these problems that are being brought to them by their partners from the corporate at the end of town and whatnot. And sometimes it could help the entrepreneurs to kind of direct them a little bit better, or help them focus.
So there's a sort of unspoken assumption that we stepped over that I just want to tease out, which is, as a founder, you need money to fund the business to grow, but the further advanced your idea is, the further closer to realisation it is, the more exciting it is, the more investors are going to be available to help you fund it. And as a founder, if you go on this VC funding path, you're taking in outside equity, and each time that happens, your ownership gets diluted. So you've got a judgment that you've got to make as founders. So I would say leave it as late as possible. If you can fund it yourself for a period or prove up your idea before you actually go out to outside investors, and have them buy into your business, you'll get a higher valuation, you'll have potentially more funding available, a wider range of investors to choose from. So I think it's often a mistake to just go straight out and raise outside capital if you can push that business that bit further on your own before you do that.
So there's a bit of an argument brewing here, like, soon, don't talk to me at all.
I think there's another.
I like an
extreme.
argument. It's good.
Yeah, and I think two things I will add is we're talking about doing diligence, like us doing diligence on you and having a long relationship over a long period of time, and that helps us to get to know the founder. But you should 100% be thinking about doing diligence back on your VC. So having a relationship with them over a long period of time gives them an opportunity to prove their worth. We're talking about marriage. I think there's a sad fact that the average VC investment lasts longer than the average marriage. So it is, when someone's on your cap table, it's scary and sad. But yeah, so you should be doing as much diligence as you can on your VC, and having a relationship over a long period of time. You can test that, and also understand if they're the person you want to work with in the long run. And then the second point, to the point around, do you raise capital early? Do you raise capital late? Not all businesses should raise capital. And I think we were having a conversation earlier around, you see this measure of success, company raises $1 million, in the AFR. The hard work's getting started for that founder now. They've got the pressure of an investor on their cap table. They've got different pressures that come with managing cash, as we were talking about. So there are many great businesses that can be bootstrapped, and they might not have the return profile that would be attractive to an investor, like us sitting up here, but doesn't mean that's not a great business. So, for Airtree, if you're looking to go down that path, it's never too early, similar to a lot of the comments on the panel. You should be using the opportunity to diligence on us, but also think about whether raising capital at all is the right approach for your business.
Okay, so trying to maybe distill that a bit, there's angel investors as well. What is your advice for? Don't talk to them. What are your thoughts on approaching angel investors and having those? Do you like to see angel investors on a deck, or do you? What are your thoughts on angel investors? It's a broad topic, but
Yeah. Like, I mean, I'm both angel investor and VC, so it's kind of sit on both sides of the table. I mean, it's different types of investors, and basically, as just was said, I mean, you need to understand what investors you need in your business, if any. I mean, quite often I give the advice to the founders that they shouldn't raise any money at all and just keep bootstrapping it, because they can probably get to the outcome which would be right for them, but not necessarily for me as an investor. Because, if any investor would get involved, they're obviously looking for a return on their capital exit at some point in time. While as a founder, you might just want to build like a lifestyle business, which would make you a very nice earning, and that's it. There is nothing wrong with it, but just not the right business to raise venture capital or even angel funding into. But obviously, it's kind of upstream and downstream investors. They're all an important part of that ecosystem, and I think that without a significant community of angel investors, it's very difficult for the VCs later on to even get involved, because there are not going to be that many companies to invest in, and vice versa. For angel investors, it's very good to have good relationships with the VCs that invest later on, and the more kind of trust there is in that relationship, the easier it will be to kind of progress to the next step. But for some companies, angel investors, that might be all they need. For some others, it would be this one step out of the 20 steps, on reaching Mount Everest.
Fantastic.
So, I should say, keep it simple. If you've got the choice to go with a VC that can write the first check and then follow you all the way through, I think, as some of my peers on the panel can do, that's always going to be a better path to go down versus angel investors, which really can't follow you all the way through on that journey. Potentially, they also can't help you in terms of operational advice or opening up their network to you or other things. If you're going to go down the angel path, because that's where the capital's available, fair enough. The one bit of advice I'd give is try to keep the absolute number of investors as small as you can. I think some businesses come to us at a later stage that have already got 40 or 50 investors on the cap table. It needlessly complicates decision making and governance, and you find as a founder that investor relations becomes a very big part of your job very early on in the journey. So if you can avoid that and just get a small number of supportive investors early, I would do that.
The only other thing I'd add to that is just expect very little from your angel investor. If they provide a lot of help, and great, that's a great outcome. But the reality is, for most of them, it's not their day job unless they're a super angel, and there's not that many of them in Australia. So just be prepared that they'll look good in a pitch deck and they can give you money, but assume that you're getting nothing from them. It's just not their day job, as opposed to a VC whose job it is to look after their investment in your company.
Well, Andrey and Alicia mentioned getting married, and I think not to each other, of course, but having a long relationship with an angel or a VC, I think, is a key thing. Not to go too soon. Obviously, what do you tell people when? How do they get to know you guys better? What's the good way for? Because there's cash, there's expertise. There's cash is certain, but expertise is sometimes yet to be proven. So what do you tell people about the slow? Don't get married too soon, Andrey. And what do you tell people about getting to know you guys?
There's a lot of ways, as we discussed earlier. VCs are generally quite approachable. We've got a lot of events, blogging, our contact details are all over Twitter, so you can find ways to get to us. I guess in terms of my advice, if you're going through a diligence process, and what's the way to get to the crux of it, because typically every VC will say they're very founder friendly and talk about all the services they offer, which are all great. But my advice would be speak to some founders in their existing portfolio. So if you are seriously considering working with a VC, ask for some introductions to portfolio company, or go to their website, find out their existing portfolio companies and reach out to their founders, because they'll give you an honest opinion of what it's like to work with that VC in the good times and bad times. Unfortunately, there's going to be some bumps in the road, and I think that's sort of a pretty good benchmark for what you can expect once you partner with them.
Fantastic. Anyone else want to grab?
Yeah, so I agree 100%. I would probably go even one step further and say, ask the investors to speak with the companies that they invested in previously that failed, and then see how what's the feedback from the ones that failed. Now, with me it's fairly easy. At least 80% of what I do fails. So it's very easy to find company that I invested in failed, including ones that I built myself. But it's a long road. There are some companies that I invested in 13 years ago and still going strong. Obviously, because I mean, typically, if you're kind of on the not on the right path, it wouldn't take you 13 years to realize that hopefully. But it's very important to get into that relationship with your eyes open and understanding where you're getting into, and then again acknowledging that later on down the path at some point there would be a conflict of interest, and one thing that could be great for the founder would be very, very bad for the investors, and vice versa. As long as both parties understand that, and then again, unfortunately, a lot of founders I meet they don't really understand how the VCs actually work and what's their kind of financial model, and what's the lifetime of the fund, that the fund only typically invests 4 to 5 years and then they divest. So I mean, it's maybe not a good idea to talk to a VC which is in its 4th or 5th year of investment if you think it's going to take you a decade to build a business, because the investors are going to get very anxious too soon. So it's a lot of these things that you just need to understand. Again, very, very similar to just a regular relationship. Just get to know the other party, get them to know you as well.
Great, yeah.
So my favourite thing to do is go for a drive together. I find when you actually go for a drive with someone, you find out a lot about them. So if they're F this, F that, well, that's probably going to give you a pretty good feel for what they're like in a boardroom.
Uh-oh.
If the VC lets you,
Yeah, exactly. Actually, well, speaking of one of the things you touched on, Andrey, was you're not identically aligned. So when the next raise, and I know Alicia and I have had a quick chat outside about not necessarily wanting to lead a second round. So what advice would you give people about how to think about getting the best out of your relationship when at a second round? Like everyone's looking at the same information at round 1. Round 2, the founder's trying to get a higher valuation. You're saying, well, great, I don't want to lead it, so therefore I don't have that conflict. How do you manage conflicts with that, and how do you get the founder to go for the right level so they don't go hyperspace too soon in terms of their valuation?
I mean, in my case, I'm typically, very brutally honest with them. I think if they're raising money at a valuation that, in my eyes, doesn't make sense, it's not only I won't lead the round, I won't even participate in the round. I'll tell them I can't even refer it to my network because I think, you're asking for something ridiculous. And again, being in this journey many, many times as a founder myself, so it helps me kind of talk to the entrepreneurs, on an eye-to-eye level, because I typically don't try to teach them anything, more just share my personal experience or what I've done in other cases and say, okay, I've made a mistake here. It cost me $5 million. Just go to the left or the right, save the $5 million. I already paid for it, so it's a free lesson for you. But yeah, I mean, just being honest.
Good start. Alicia,
Yeah, I mean, I think in terms of valuation and in the negotiations around that, I think the thing to consider is you do sometimes have conflicting interests there, but ultimately how we operate is thinking about what's setting the company up for success at the next raise. So you can get away with one raise, maybe having a very high valuation, and maybe there's an investor that's willing to put money in at that valuation and the founder's happy, but then you've got to think about what the impact is on the next raise. So if that's your last ever capital raise, then take the highest valuation, minimize your dilution. But if you have the plan to then raise again in 18 months' time or 12 months' time from that point, how are you setting yourself up for success to have an uplift? We say down rounds don't happen. So if you need to then do a lower valuation for your next round, it's a very bad signal to market. So it's about setting what's the valuation that you can justify based on your metrics. You can get the best possible investors involved. So, often we'll lead early stages. We may lead follow-on rounds, but to your point, sometimes we'll do our pro rata in the next round. We help bring on the next best investor, whatever they might need for that next stage of growth. And how do we bring on the best possible investor? If you set some type of crazy valuation, you might, to your point, scare off a strong investor that could add a lot of value and could help you get to that next meaningful milestone 12 months later. So it's a balancing act between minimizing dilution, which is totally understandable, versus setting the business up for long-term success.
Okay, well, let's just change gears to the people in the room that are going to make the money, the founders. Right. So, what do you look for in a team and the weightings that you apply, and assuming, maybe even one red flag that's just a complete no-no. Well, how do you guys assess teams and, it's not easy assessing people because they're weird.
They're
I'm
irrational.
talking about you, Matt. Who wants that one? Andrey's got the...
People are irrational, and that's one of the things why you can't assess, irrational creatures with rational methods. So I think one of the things that I'm looking for in teams is a diversity, and that's not, it's not this kind of fashionable slogan. I'm actually looking for a diversity in terms of their experience, and not all of them being engineers or Big Four guys with zero on the ground experience. No offense, for management consultants and everything, but
Get it out up front.
Yeah. No, I mean, it's. I always say it's very easy to say on the comfy couch and give advice to others. It's much more difficult to run in the trenches and actually, do the day-to-day fighting. But I guess my perfect team would be 3 people. Someone with a business experience, someone with a marketing experience, and someone with a vast technology background. I see more and more teams that are saying, okay, well, I'm a non-tech founder, and I'm looking for my CTO, the kind of 2 years in. I mean, that's fine. There are some companies that were built this way, but the majority were not. You do need to have this core experience in your team, and if you don't have it, well, go out there and find it. It's much easier to find that than to find money, for sure, because you're also willing to give very nice equity stake, hopefully, if you're reasonable. But that's to me it's very, very important, and a significant bonus would be them having some sort of common background, whether being work together or study together, or even served in the military together, whatever. But something that would give me a little bit more confidence in their ability to survive this long and very, very tough journey. Because again, a lot of the companies I've seen are falling apart simply because the founders just drift apart, and then it becomes mission impossible to win this fight.
Damian, you want to say something?
So I think the single most important trait is an ability to sell, and that's not necessarily selling the product, but it's also being able to sell to your peers, to your employees. When you've got nothing, it's very hard to get people to come and work for you. And you see those really, really good entrepreneurs, people just naturally gravitate to them. And even though they haven't got anything, they've been able to command incredibly high valuations, have been able to sell the vision. And so if you can sell, and at the end of the day, if you actually have physical sales in terms of revenue, that solves a lot of issues when it comes to dilution if you don't have to raise again. So.
Great.
Agree with everything that's been said. Probably the one thing that we also look out for is obviously there needs to be a passion and commitment to see the idea of the business succeed, but that needs to be balanced with, I think, a willingness to bring in others as the business grows, to build a strong team around the founders. I think probably where we've kind of seen missed opportunities in our portfolios where the founders feel like they can do everything themselves and they just don't want to bring in others and supplement their own expertise and their own capabilities. So we see that as a kind of critical success factor.
Okay, guys, well, let's go up. Alicia, do you want to say something?
Oh, no, it's just, echoing a lot of the thoughts on the panel, but, deep domain expertise, a visceral connection to the problem. We look for founders that, this is their life work to solve this particular problem. As Damian mentioned, evangelize their vision, so the ability to bring on not just more capital, but the right people around them. Commercial hustle, resilience. It's a really tough journey, and looking for people that can make it through the ups and the downs. And then probably self-awareness and the ability to pivot when needed, because things do go pear-shaped sometimes. And then to Andrei's point around, we look for a very similar balance. An ideal founding team would be, technical growth and product expertise together. You see that you look at Canva with, Cliff, Mel and Cam. They've got that nice balance. That's sort of an ideal founding team because you have the 3 skill sets and they can build the team out underneath them. But if we see a trio like that, it's pretty exciting.
Fantastic. Well, let's step it up a gear for some of the failures and maybe teams that you've thought were that brilliant team you've described, and What do you? Let's talk about some of the failures, or particularly what has gone wrong with teams, and what early signs there are in teams going wrong, and maybe even how you can help either stop or change directions as well. Maybe. You want to?
I mean, we never make mistakes as VCs, right? No, I think something that we've reflected on. We've done a whole analysis of our existing portfolio and looking back, and something that and I've experienced personally the extremes of corporate culture. Working in businesses with not the best culture, and then working in business with phenomenal culture. I think even when we look back at our IC papers for some investments, we had a little bit of question marks around that. We were able to identify it. We maybe underestimated just how important it is. It only becomes more of a problem as the business scales. So I think culture is something that is super important. So now as part of all our investment processes, we go and spend time, like literally just turn up to the office, walk around the desk, talk to everyone in the team. It's really important because you learn so much more about that than you will on a diligence call with the founder, or trying to unpack what the culture might be like. If you go to the office and live and breathe it, you get a much better feel for what the culture's like.
Oh, we're not just letting one of them off the hook, Come on, there must be some other failures or some things you saw that went wrong.
So something interesting I thought I'd bring up is A16Z recently published. I don't know how real it is, but the performance of one of their shadow portfolios. So what they've pretty much done is not just the success of their portfolio, but the ones that they came very, very close to, but then didn't quite get there. And interestingly enough, the shadow portfolio outperformed the current portfolio, which at first you go, oh, that sounds a bit funny, but actually can make sense, right? Because it's a risk. If the reason you're not investing in that particular company is it's for that, for that price, or where the stage the risk is sort of just off the scale. So, in that case, it's performed better, but that's just because they've taken more risk, and so it's not necessarily a better investment decision. But yeah, so I don't know, just a tidbit, anecdotal note.
Actually, a very good point. I'd like to pick up on that. I think that, again, at least in my view, VCs are getting paid to take risk. And there is a very interesting thing that some of the very well-known venture capitalists said that if we're not failing at least 60 to 70% of the time, we're not doing our job right, because we're just making safe bets, and that's what the banks should do. But the VCs, obviously, the investors who invest in VC understand that it's a highly risky asset class. Well, in Australia, particularly, I think over the past couple of decades, the average return was like minus 5.5%. So I mean, obviously, it's quite risky, but the returns are asymmetrical. Like, I mean, in a portfolio of 20, 25 companies, you could have just one company that returned the whole fund 3 times, if not more. So that's essentially all you need as a VC. Now, and that's something that the founders need to understand, that from a VC perspective, unless you're very, very exciting business and you could prove it very quickly, most of the VCs would lose interest in you very, very quickly as well, because they'll just realize, well, best case, you're going to be just this average performer, and I'm just not going to spend any time on this, because, to me, average performer or complete write-off is pretty much the same thing, because, I'm not getting paid to return the capital that I've taken. I'm getting paid, to return much more, and that's why taking VC money introduces a whole bunch of these, extra risks to the business. But again, hopefully, if the only risk related to that is that you're risking for the VCs to get disengaged if you're not this kind of shooting star, well, you can live with that, but you should definitely be aware of it.
So, when you've got all these rules and term sheets, etc., what are some of the things that you've seen really good founders do that have even let yourselves cut your own corners? And how's that turned out for you? Are there any examples where you go, you've had to fight with your partners over someone, or how's that gone when you've gone against the crowd? When in the VC world, you've all got your own investment committees, but when you're an outlier, you're really going hard with one founder. You're saying, I love this person, but no one's, and you eventually get your way. Well, how's that turned out for you? Does that happen, or because just going back to that question, these guys have other people's money, so there's a process, and I wanted to know, do you stick to your process always, or are there some founders that are so good you go a bit harder for them and sometimes bend the rules?
Yeah, I mean, our job is to develop conviction to what you mean. So we talk about, at Airtree, smacking your hand down on the table and fighting for this investment to get through. And it's my job. If I'm passionate about investment, it's my job to bring the rest of the investment committee on that journey. So you might start with people not being on your side, and that's your job to build that conviction and sell, as Damian mentioned. So that's a big part of our job. We typically have a weekly investment committee meeting. But to your point, when you find an exceptional founder, you need to be flexible. You need to make things work. I can think of one portfolio company in our portfolio that I think someone on our investment team had a phone call, and then the next day, they're based in Melbourne, the next day a partner and this member jumped on a plane down to Melbourne, I think it was the day before Christmas, to make this investment happen. Like, you just drop everything when you find an exceptional founder. And they're now a portfolio company, have been for a few years. So we do bend the rules because we need to, our number one job is to find the most exceptional founders in the country. So when we stumble upon them, we need to do what it takes. And then you need to bring the rest of the team along on that journey to have the same level of conviction you do.
Fantastic. So one thought is, obviously there's a lot of VC money out there, overseas, etc. What advice do you give founders to either take your money plus another US VCs or Chinese VCs? How do you interact with other VCs and partner with them, and particularly how do you work when it's time for someone to go to the US? How do you help people and get more people around the table for the next investment round?
If your business is exciting and you've done your job right, selling it during the fundraising, you'll have access to a wide range of investors. And I'd say, as a founder, you're trying to balance valuation on the one hand with the ability for that investor to really help you get the business to the next level. So what can the investor do beyond just give you their money? And it might be experience they've had in their portfolio or personally, or it might be they're opening up a network, or for corporate VCs it might be that there's a business relationship they can offer you that'll propel the business forward. And I think as you kind of move along on that journey, that becomes increasingly important beyond just the valuation you're getting. I think the ability for the investor to really help you in other ways beyond just money and valuation. And if we're already there in the investment with the founder, that's kind of a key consideration for us. I think if the company's opening itself up to new investment, what does this new investor bring over and above just money into the next round?
Anyone else want to answer that before we open it up for questions?
So we're slightly different in that we've got a global mandate, so probably 40% of our portfolio is actually based overseas. So we'd consider a US investor like any other co-investor in Australia. If we decide that the right decision for the business at that point in time is to take US VC or a big strategic or whatever that may be, we'd obviously make open doors and make the introduction not just to the right company, but not to the right investor, but also the specific partner that is best appropriate for that next round.
It might be time for you guys to ask a couple of questions because they look like they've got checkbooks loaded.
I guess I had a question. There was a report released recently that Australian VCs are not deploying capital quickly enough, not taking enough bets. I'm sure you've all seen the report. How do you feel about that? What are you doing to sort of, be more open to taking bets more quickly? And what are you looking for in that area?
It's the report by Oz Industry, you mean?
I can't remember the name of the report, but
yeah. We actually analyzed the data in that report. So, the data is real. The rate of growth in the VC money had slowed down significantly. I think by a factor of 5. So that's the facts. And I think probably a couple of years ago there was an influx of a whole bunch of VCs raising substantially larger funds than what we used to have around here, like 250 mil. I think at least 3 or 4 funds raised, this kind of money. And and it's actually not that easy to deploy capital because, like again, as I mean, it's not like you're running around on the street and handing checks to everyone you see. So if you want to deploy the money responsibly, it's actually not that easy. And assuming that a majority of this money is reserved actually for later stages and your follow-on investments, and then some of these follow-ons don't really materialize, then you kind of get stuck because then suddenly you have like $150 million or $200 million just lying around that you thought you're going to deploy, and you built a very nice Excel model where everything fits, but then then there is life and it doesn't fit into Excel. But I mean, in Australia in general, we obviously have the tendency of on one side playing it very safe. So, investing in real estate and, well, I wouldn't call mining really safe, more like stupid, but whatever. But, it's kind of, let's say, whatever. But on the other hand, I think up until maybe a couple of years ago, we were betting more on Melbourne Cup in one day than all the money that was invested in startups in a whole year. So, I mean, VC money per capita, obviously, Australia is measured somewhere like next to some countries in Africa, I think. So we're not doing very good. We definitely have room to improve. But on the positive side, I came to Australia in 2010. Back then, I mean, it took me 2 whole years to find the first company to invest in. Now things are, a little bit more vivid, I would say. So I think, we can definitely improve. But there are a lot of things that are a process, and you can't just jump from 0 to 100 overnight. It takes probably a couple of decades to get there.
I mean, I can't speak to the industry as a whole, but we've never had any trouble deploying capital in our funds within the time frame we set for our investors. I think we're really happy with the quality of the opportunities we see. When we see a lot more opportunities than we invest in, but in terms of the selection available, they're very high quality companies coming through now that we're very happy to invest in, and the choice is actually often a difficult decision with only a limited amount of capital to deploy. So, yeah, as I said, I can't speak for the industry as a whole, but I think we're really pleased with where the ecosystem is.
Okay, my name's Tim Lee from Fractonian. Quick question, great observations so far. My question is about global scale in terms of, do you prefer to see thinking global, act local, or thinking and acting global from day one?
So for us, I don't think we really care. It's just a question of how big the addressable market is. Certain opportunities by their nature are global, others are not. To be honest, it's like any other consideration in investment. Doesn't really make a difference to us.
Yeah, so for us, we only invest in global companies, and because we specialize in this cross-border transaction, so we're 4 partners, and I'm the only one based in Sydney. We have 1 guy in the Valley, 1 guy in Beijing, 1 guy in Tel Aviv. And I mean, for us, if the company is not thinking global from day one, well, maybe they have a $1 trillion local market, but in most of the cases, they're just not, thinking big enough.
I think we're similar in that it depends on the business and the particular addressable market for that business. So I think fintech is an example where there's a lot of opportunity locally in Australia. Prosper's an example in our portfolio. They're targeting an Australian market, but it's SME lending is a huge market in Australia. So and then there's portfolio companies that it would only make sense to be global from day one because the market just isn't big enough in Australia. So if it was a small TAM, we would want global from day one. If it was a very large TAM in Australia, then we would be happy to back that business.
I think there's one more.
Hi guys, my name is Bharat from UpperMate. Thanks for the panel. I have lots of questions buzzing, so I think I'll just stick with 3 questions. The first one is, during the startup stage, when the business is not making a lot of profit, what are the different common valuations that you guys kind of approach when they're not making profit yet? And then secondly, about the growth, you talked about how just one company in the portfolio makes all the money, so you expect a very high return, right? Is there a minimum growth rate that you would expect? Is that like 50% growth or 100% growth? What's the minimum growth that you guys would expect before you invest? And then lastly, in terms of exit, is your exit always through like acquisition and IPO? And the founders exit, can the founders exit through VCs, or always the founders exit come through like the final acquisition by Apple, Facebook, or through IPO? So valuation, growth, exit.
Yep, so valuation profitability, that's what I heard in the first question. I can tackle that one. So most of the businesses in our portfolio aren't profitable. So we're comfortable with businesses that aren't profitable, valuing businesses that aren't profitable. That's pretty common in our worlds. I think what we look at rather than profitability is unit economics. So we want to understand, are you sustainably growing? You can throw money at something and it grows, but whether that's sustainable or not, whether that makes sense at a unit economic level. So how much are you paying to acquire a customer? When do you get payback from that customer on a contribution basis? They're the kind of things that we look at to get comfortable with a lack of profitability in the short run. We know that you're in control of that and you can get to profitability in the longer term. In terms of valuation, it depends on the business model, but often it's a multiple of revenue. So there's SaaS rule of thumbs, there's marketplace rule of thumbs for a multiple of revenue. For fintech, it might be net interest margin multiple. So it's typically a multiple of revenue that gives us comfort. That's not just for this raise, but again, thinking about what makes sense for the next raise and then what eventually it might exit at. So that's how we get to a point. At a very, very early stage, when you're pre-revenue, you can't even give it a multiple of revenue because there's no revenue to put a multiple on. So for very early stage businesses, if you think about raising capital, you typically think about how much you need to give yourself 12 to 18 months runway, because you don't want to think about capital raising every 3 months, as you're not going to be able to grow the business. And then you think about how much dilution you're willing to take on. So rough rule of thumb, maybe 20% a round. If you're planning on doing several rounds, you want to make sure you still have a meaningful amount of equity at the end of that. And so you'll raise as much capital as you need to get you to that next milestone, taking into account dilution, and evaluation will fall out of that. Knowing that when you get to the next raise, you'll be valued based on metrics. So you don't want to set such a high valuation that you can't grow into that value. So that's how I think about valuation at early stage.
Right.
To try and keep it simple. So our investors expect our funds to return 3 times money after fees. And we know that a number of the investments are not going to be successful, and consistent with the comments that my colleagues made earlier. So the ones that are going to be successful need to return more than 10 times the money that we put in. So we have to... Sorry?
What period?
Well, over the life of the investment. So we've usually got a 5-year investment time frame. So 5 years investors give us to invest the money and then 5 years to get it back to them. So over 10 years. So the ones that are successful we have to believe are going to be 10 times money. And we have to believe that on every investment because we know that some of them are going to fail. So from a valuation point of view, yes, there's benchmarks and all the rest of it, but we need to be able to make the case in our own minds, yes, this could grow to 10 times return, having regard to the time frame and how much money the company's going to have to raise along the way and all those other things. We just sort of apply that simple rule.
So just with those numbers he gave, that's specific to his fund, given how later stage they are. So for some of our earlier stage investments, for example, you take a lot more risk. A 10x return would be a disappointing outcome. So it just depends on the nature of that investor. And I mean, the question that you're really asking is how long is a piece of string? How would you value a company on the ASX 200? It's depends on the type of company. It depends how progressed they are. There's lots of different factors there. So.
All right, well, if there are no more questions, I'd like to thank Alicia, Andrey, Damian and Grant.